Ready?
Yeah. Can you press the full screen? Sorry. Hello, my name is Taylor W, and I want to welcome you all to my independent study and mentorship presentation. So a little bit about me. I am a senior with Frisco High School, and for the past 4 years I've been on the Stars dance team. And this year I have the honor and privilege to be a senior lieutenant, which is really good for leadership because I learned a lot about it this year. I've learned that you need to push others and how to push others without coming across as negative or pushing them too far. I've learned how to get other people accounted for and in line, and I've learned a lot about teamwork through this year. I'm also part of DECA, which is a marketing and business club here at the school, and we help run the school stores, so it's good practice for day-to-day operations. I'm also part of Student Council and Student Climate Committee, which are both organizations which help the environment of the school and to get the school more festive, spirited, and ready for the real world. Finally, this year I'm also an NHS tutor, and I started that this year. I didn't think at first I would like it much because I'm not too good with people. I'm still learning how to become better acquainted with others easily. And so I decided to do math because I do love math, and the kid I'm working with is actually really great. He's a great learner, and I'm really excited to work with him throughout the year. It's taught me how much I love to teach others, which is good for any team that you have. The biggest thing to know about me is that I am in love with Disney. I have a passion for Disney, and I believe nobody truly outgrows Disney. So my biggest hero is Walt Disney, and he once said, "All the adversity I've had in my life, all my troubles and obstacles have strengthened me. You may not realize it when it happens, but a kick in the teeth may be the best thing in the world for you." And I had my kick in the teeth a couple years ago, and because of that I've learned to really take life in the moment and to think long term, but really try to live in the moment because you never know when it might end. This year I'm studying financial management because I hope to become a chief financial officer when I'm older. So the chief financial officer, we handle anything and everything that has to do with money in the company. We make sure that the financial reports are in order, that all the tax statements and taxes are on time, that the budgets are appropriate and ready to go, that all the investments are in check, and everything else that has to do with the company. So it's a pretty big role because if we messed up, the entire company could go down in flames. So we also need to constantly look for market trends, and because that can often determine the financial plan for that year. So if we see that perhaps transportation is lacking this year, we might try to tighten the budget or maybe expand it for transportation and shipping, things like that. A lot of people don't realize how much our role really depends on the company. A lot of people know that the company depends on the CFO because we do handle all the money, and a business is all about money. But our role largely depends on the company too. So for example, in a private company, those are usually smaller and don't have as many restrictions. So our role could be expanded to many other roles such as COO, or maybe even stepping in for the CEO once in a while. And we're able to tour the facility more and get more hands-on with people. And that's because it's a smaller company and therefore privately owned and can kind of do its own thing. If you're in a public company, however, those can be much larger and have a lot more restrictions and guidelines set forth not only by the government but by the board of directors as well. So your role could be very limiting to just finance and such a thing. And that's not bad either because it is a large company, so you can get more experience. And finally, a major role for us is teamwork, because we do get everything that has to do financially. If we were to handle it all ourselves, we would be drowning in paperwork and we'd probably never get any sleep. So we really have to rely on trustworthy people to help divvy out the work and help make sure everything gets done in a timely and efficient manner. So we started off this year with research assessments, which is where you find an article and then you write about what you learned from it and how you can apply it to your own life. At first, the articles were really easy to find because there was a pool to choose from, and I haven't chosen from any of them yet, so it was all very easy. But as I started choosing more, it became harder and harder to find. But two of the ones that really stood out to me was A Route to the Top and Eye to the Future. A Route to the Top talked about the best way for women especially, but men also, could get to their role that they desire in the chief executive office. And they really emphasized education, experience, and growth. So education is obviously, if you want a high up role, you kind of need higher education, so going to college. And for CFO, that would be getting an accounting major, finance major, or economic major. And I'm going to Texas A&M, and I'm going to get an accounting major next year, so check mark on that. The next thing they talk about is experience, which is once you've graduated, like getting in the company and learning about them, learning their ways, learning how best to do your job, and getting experience from working hands-on, which will then lead to growth, which is growth of a company and yourself, because your job is to help grow the company, and as you grow a company, you learn more things and you can grow yourself. And through growing a company, you get more merit, and through those merits, you climb up the ladder. So it's a very, very flowing process, and everything comes together. Next is Eye to the Future, which really emphasized the trustee relationship, which is something not a lot of people think of for CFO. Often the role of CFO isn't really behind a desk checking numbers. It's actually a lot of traveling and meeting all the big investors who invested in your company. Because you have to make sure that the trustee relationship, you have to make sure that the trustee relationship is really good, or else then they'll take the money out of your business and that'd be it. So you have to really, it's a lot of traveling, a lot of meeting, and making sure everyone is happy. Next we had interviews, and starting off I was a little bit stressed and awkward because I was nervous. I've never been the interviewer, I've always been the interviewee, and so it was interesting being on the other side of the table. I went with Walter Floyd at first, who is an accountant, and it was interesting. I would ask a question and he would answer it in like about one sentence, and that'd be it. So it only lasted about half an hour, and I learned from there that I really need to try to get the conversation to flow more as opposed to just asking questions. And so, and the next one I had was with Mike Russell, who is now my mentor. So what I learned to do was to ask a base question, like perhaps about their past, or maybe what was their favorite thing that they ever done. You ask a base question, and from their answer you branch off and ask more questions and more questions. And so it's almost like a tree. You just keep on branching off, and it actually creates a really long flowing conversation that's easy to get from and gets you a lot of information. And that interview ended up lasting almost an hour or more, so it was really good. From there I met Stephen Bell, who is the senior accountant for 7-Eleven. And when I first went there, it was a beautiful headquarter in the Dallas Art District. It was so pretty, it was modern and new, and I loved walking into it. Excuse me. And so once I started talking to him, about half an hour in, I eventually gained his trust just as he gained mine. And he actually showed me the financial statement for the year before anyone else saw it, like before his boss even saw it. And it was so cool because it was all these like categories and lines filled with numbers, and at first you don't really know what they mean. They're just like numbers on a page. But he pointed to a column and he goes, okay, so this is in the billions. So we have X billion dollars that we budgeted, and we saved Y billion dollars. And it took me a second. I was like, billion? We're talking like billions here? Like could I have some of that? Like, it was crazy. And then he pointed to another column that was more detailed, and he was like, so these are in the millions, and this is how much we have now. And it was crazy to look at, because like all these numbers on a page you think don't mean anything, but they're actually like billions of dollars. So it got me really excited, and I hope to see that more in the future. Then I had Ivan Maskey, who was recommended by Stephen Bell. Ivan Maskey also worked at 7-Eleven. He worked on a different side of the financial area, and he is from England. So when I first interviewed him, he would sometimes talk really, really quickly with a kind of thick accent. And it was difficult for me to pick up what he was saying, so I had to ask him to repeat things 2 or 3 times, and that was a little bit embarrassing for me because I could tell he got a little bit frustrated. And so I learned from that I need to start learning and speaking to other people from other countries so that I can pick up on the language quicker and therefore seem more professional when I talk to them instead of having them repeat everything. I then interviewed Biggs Porter, who is also a CFO, and he was a much older gentleman and very wise. So he offered to give me a lot of advice for going in. And a couple of the biggest advice he gave me was, one is rely on your team, which I kind of touched on earlier, is really divvying out the work to your team and making sure that you get sleep and they get sleep and everything is done correctly. But the second part of that I didn't really touch on is that you also have to teach your team. So as you give them new work, you might want to give them a new project that maybe they've never worked on before and they weren't really taught how to do. And so as you give it to them, you can teach them, which will then refresh yourself and give them something new to learn, and therefore growing the company as a whole. Because as your employees grow in knowledge, everything can get done quicker and more efficiently, and therefore your company will grow. Finally, I had confidence calls, is what I like to call them. So Mike Russell introduced me to Sharon McCollum, who is one of the top 10 CFOs in the nation, and she is currently the CFO of Best Buy. So it was a huge honor just to get to know her. But sadly, she lived in Michigan. So seeing as I couldn't fly out there and interview in person, we decided to do a conference call. And so I've never really done a conference call before, so I was a little bit nervous. And it was interesting because I had to keep my voice low and level so that it wouldn't come off as high-pitched on the phone. And at the end of it, though, she always talked about how, though the women in the CFO role are small, like the percentage is growing, and she could easily see me reaching that level in the near future. So it really left me feeling confident and happy that she would give me that praise. My mentor for this year is Mike Russell. He is the CFO of Continental Wireless, and he has now switched over to Wheels America, but still keeps in contact with Continental Wireless. And the first time I met with him, I already sent him the mentor handbook beforehand, and he had a lot of questions, which told me that he cared a lot. So after asking all the questions, he went through the future expectation and experiences that we both want to have. And it was really nice because he even talked about how I would be sitting in on conferences with him, how I'd be taking notes, how I'd be seeing the financial statements and seeing how he deals with other people and like loans and everything. And it was really cool. And then after that, he let me tour this facility, which was interesting to see how all the different people work in their own little niche but still work together. And I thought that was really cool. And so far, he's helped me a lot on all my projects. And he's taught me about 4 years worth of college in a couple months due to my financial statements. So he's been a major, major help. So my original work was the Disney Store investment projection, which is where I got together a packet that I would give out to any potential investors in my Disney store so that they could invest in the company and I could get it started. First, I had to research all the varying types of investment and so that I could put it in the packet and introduce it to others. There's 2 main categories of investment, which is personal and business. So personal is what investors will look for in a business. First thing to know about that is that there are risk levels that every investor will want to take. There's a low, medium, and high. So low and medium investments would include bonds, savings accounts, mutual funds, DIS, anything that is basically guaranteed for you, that you'll have money in it and that if not, they'll back you up. And there's very little chance of loss, but that also means that there's very little chance of reward because most of those will have 1, maybe 2 interest rate on it, so you won't be getting much return. But that's okay because your money's safe. Then there's stocks, and stocks have all 3 levels, including the high. And so low and medium levels in stock would include franchises, technology, government corporations, like anything that's bound to last a long time. And the reason I say franchises is because the multiple stores mean that more people recognize it, and that means it's going to be there for a while. Because take McDonald's for example, they haven't gone out in almost 80 years or more. So, and I don't think they're ever going to go out for a long time, and that's because they're a franchise. It's recognizable around the world, and therefore they're more likely to stay the same. High-level stock, however, is when you deal with companies that could flip on a dime depending on scenarios, really. It could be one situation that could make them plummet for a good 10 years. And this would include steel, transportation, and any mining thing. So for airlines, say that there's a sudden crash due to, I don't know, an oil problem. That could mean that their stock goes way down for several years. On the other hand, though, if there's suddenly a major concert in Dubai and everyone in the world wants to go to it, their prices are going to go way up because it's a major event. And therefore, you could get a ton of money or you could lose a ton of money. It's a high risk. The investor will choose their risk level based on where they're at in their life and what they look forward to getting or what they need. Then an investor will also evaluate a business before they buy into it. So they will evaluate in terms of potential growth, current price, competition in the market, and so much more. Potential growth is because whenever you buy a stock, in order to get anything in return, you have to sell it. And you're not going to want to sell it at a lower price or the same price because then you'll get no profit. So you have to really make sure a company has a lot of potential growth in the future, so that whenever you do sell it off, you get more money instead of less. Then there's also the current price and the competition. So say a company has a lot of competition within their genre, then maybe that might not be the best for you because you don't want a lot of competition. You don't want to deal with the friction. But some people might really enjoy that because it's like a fun energy boost for them to see if their company makes it or not. Then you also want to make sure that the company's morals and values and interests are the same as yours. So maybe if you know nothing about technology and don't really have an interest in it, you wouldn't want to buy from it because you wouldn't know what to do with it. So it's really about making sure what you're interested in is what the company is doing. So for business, that is what a business needs to look for in order to get investors. That's what a business does to grow, is their type of investment. Some risks that we look for before we invest in anything is inflation, liquidity, and political risk. So inflation risks include, inflation is always there. It's not going to change. However, it's at a higher rate than usual because of the cycle that we're at. You don't want to get any loans or any bonds or any shares at that time because the higher the inflation, the less people will want to buy it, which will inflect your liquidity, which is the ability to sell investments quickly, and that demonstrates demand. So you want to be able to quickly get out of something if need be. Like say you got a bond that lasts 10 years. If you have a car crash in the next 2 years and you kind of need the money, it'd be hard to get out of and not exactly the most ideal situation. So for an investor looking in, they want quick liquidity and they want it now. So it's important to make sure that your business always has that. And finally, political, which is if you're a business and you're trying to expand and you're buying new property, you got to make sure that where you buy your property is in accordance to your ideals. Because political risks include the local tax, the local laws, the local controls, like anything that the government might want to do. And so if a tax is really high in one place but really low in the other, you might want to move to the other place because it'd be better for you and your business. And you have to make sure that wherever you're moving to, you're allowed to follow the rules. And if you can't follow a rule, you might not want to go there. For investors, and for investors that we're trying to get in our company, we would look for third parties, angel investors, and if need be, venture capitalists. So third parties are kind of like a union is to an employee, third parties are to us. So they'll help negotiate loans, they'll help negotiate deals, and if a deal falls through, then they'll back it up themselves. And such things would include SBA, BBA, and other things like that. An angel investor, though, is our number one goal. Those are individual people who will buy part of your equity, which is like stock, or they'll just loan you the money themselves directly. And those are the best to get because they are very lenient and they are willing to work with you at a lower rate than anyone else. And finally, there's venture capitalists. And most businesses really try to avoid them because they usually buy out the entire business. And what they'll do is they'll grow it, they'll expand it, and then they'll sell it off for profit. That's kind of what they do. So that's kind of the last resort. And our biggest thing that we want to do is non-systematic risk, which are in-business investments that can contribute to growth, such as new buildings or getting more employees or maybe giving the employees education. Anything that you feel will make your business more efficient and grow more quickly. So as part of my original work, I had to calculate everything that I would need for the month of January and put it in an income statement. So right here you can see all the inventory I would buy for January, along with how I calculated my payroll for all the employees, along with other miscellaneous things. And then from there I calculated the amount of money I would need to get from investors in order to just start my business and in order to buy everything. So the goal was $45,000, and I got $47,000 in a matter of speaking. The owners are myself, my dad, and Miss Roosevelt. And then I also got loans from Chase and cash for loans. The angel investors who loaned me money directly was Ms. Kablowski and Mr. Stitch and more. And what I would do is I would personally visit friends and acquaintances who I knew would have the money and would be interested in my store. And I gave them the same spiel I'm about to give you all. So what I told them was that there are basically guaranteed profits in my store. Because it is a Disney brand, it's in everything. The Disney brand is in TV, movies, commercials, theme parks, you name it, they got it. So it's recognizable all throughout the world, and people will be wanting to buy the product for a long time. The store will be opening at the Galleria Mall, which an average person spends $160 per visit, which is fairly high. And the income in the area is around $100,000 or more. So that just means good money for us. The best thing about owning a Disney store is that with every new movie or product that they come out with, it creates a new excitement for the customers, and therefore they want to buy more things, because every new movie, it's like a rush for society. And so as they continue to be in business, we'll just continue to keep on getting profits. As proof of that, the Disney stock itself has only been rising for the past year. It has not gone down all that much at all. And so now we are currently at $94, and it is continuing to grow. This is my income statement and my balance sheet for the month of January. So we are expected to get a loss of around $12,000, but that's to be expected because we haven't opened yet, and therefore we can't sell anything nor get profit. And the balance sheet will show how much net worth our company is, which is actually extremely high, but that's due to the equity that people have already paid and the amount of inventory and liabilities we still have, which will soon be paid off in the next month. So this is what I plan for the Disney store to look like, and I'm very excited to open it. Finally, we have my final product for this year. It is the Disney Store quarterly financial statement, and this is what me and my mentor have worked on for a really long time. So I'll begin with the income statement. As you can see right here, these are all the net profit we plan to gain we have gained, I should say, over the past 3 months, and this is the total we still have yet to pay off. So year to date that is what this column means. It is the year to date for the first quarter of the year 2015. And that just basically adds up everything I've done all throughout the year and spits out the final number and what we're at currently. January, as I've said before, has no profits, and that's because we didn't open up yet. But the day we did open up, we got nearly $40,000 and only 500 of that was returned, but that's okay because it shows us what inventory we don't need to get for the next month. So we ended up getting a net profit of around $5,000 for that month. After that, we got $42,000 the next month, and we got a little bit less in profits and net profit, but that's because I decided as the owner I have to get paid. So because my business was very early on, I decided to take a gradual pay so that we could gradually get the profits we need without ruining the company from my own pay, which is why at first my wages were $3,000 and now they're up to $7,000 where they will stay. And as they continue to stay, the net profit will increase. So as I've said before, the income statement is basically to show your net profit. These are all the things we spend on, usually on a monthly basis, and then up here is where our profit is for that month. One of the things I learned while creating this was, at first I just took a general Excel sheet for income statements, and I would have that entire thing copied 3 times over with all the categories and everything. And it just proved to be too much to read and too much to understand. So he really taught me how to, the setup for such things are really crucial, because if you have too much going on, whenever you present it to your other board members, they're going to be confused and they're not going to look at what you need them to look at, which is the bottom line, which is why we underscore it, we bold it, we do anything we can to draw your attention to what's really important. Also, he taught me not to be afraid to fix the categories in accordance to your needs. So the categories are right here, and at first this was something else entirely, but he taught me that the wages, you would have usually one for the owner and one for the employee so that they can see how much the owner is taking out and know that they're not being ripped off, essentially. Finally, the thing I had the most difficult time with was I was not getting profits for the longest time, and I realized it's because my monthly expenses were higher than my margin. So the margin is the resale price you sell it at and the price you bought it at, and you need to have a good margin in between so that you can get your profit. And I wasn't having a big enough margin, which is why I had a loss for a really long time until I fixed it. And because most of the spending is the same every month, like for telephone and interest and internet, you're able to get a margin as you go on. Next, I have the balance sheet, which is, it shows you basically your net worth of the company for that month, and it shows you that everything is in order. As you can see, I did the profits according to product type, just to see what the inventory I should get for the next few months would be. And from February to March, clothes actually went down, and toys and dolls went up. Costumes and dolls went up. So that tells me that in the future I should probably buy more costumes and dolls as opposed to clothes, which will help me with my profits. One of the things that I learned was that year to date is not here, and that's because it's kind of a month by month thing, and it carries over to the next month. So March is technically my year to date. One of the other things I learned is that inventory, this line right here, and accounts payable, they kind of have to match. They're the ones that balance each other out, and they kind of equal each other. And that's because as you buy inventory, it gets counted as an asset because you own it and you can sell it. But whenever you buy inventory in the company, that means that they usually give you about 30 to 60 days to pay it off, which is why it also goes into accounts payable, because they still need to pay it off. Finally, I did the cash flow statement, which shows basically the transactions you take month to month in between everything else you do. So the operating income came directly from the income statement, and that is the net profit. And then at the end, this is how much I spent during that month, and how many new things I got during that month. So again, there is no year to date. Oh, that's funny, I'm sorry. So there is a year to date, and that just adds up everything along this line. And so one of the things I had the most difficult time with was whenever you do things like this, different categories have different things presented as profit and loss. So AP, the decrease is a loss, but in inventory, the increase is a loss. And that's because whenever you have an AP, if you increase it, that means that you're selling off things.